the beliefs that made Indian families rich, those beliefs are now making them poorer.
Many Indian business families who've been successful over generations have done it through a thought process and certain beliefs.
What has worked historically, that's not the same position today.
Back then, the only option was real estate, where the large investments would be.
Earlier, you could buy a house with 2-3 years of income. But today, if you have to buy it, it's 15-20 years of income.
Taking investment advice from my friends, family is enough for me to manage my portfolio.
The problem that we're facing today as families is that thought process is flowing down from the top. There is always some sort of friction between the first, second and the third generation, where the third generation understands that, okay, fine, you know what, there are guys who can do this. If we have to do this, then we need an internal team.
Having cash is a safe option, especially in crisis.
There's a big knowledge gap out there.
Welcome back to Leverage by Code, where quant thinkers take the mic, we decode the markets through a sharper lens. In our last episode, we unpacked mutual funds. Today, we go on one layer deeper. This episode is about the belief that quietly shaped those decisions, often sabotage them. The inherited market myths that Indian business families still carry forward, sometimes for generations. We're going to unpack why these beliefs persist, why they feel comforting, how they silently erode long-term wealth. Today, we have Rishabh and Gaurav back for another episode. Thank you guys, and looking forward for a interesting discussion.
Thanks, Pratik.
Thanks for having us.
So many Indian business families who've been successful over generations have done it through a thought process and certain beliefs that they carry, right? How many of those are still relevant today? What are your thoughts on that?
Sure. So, what has happened is the beliefs that made Indian families rich in the generations, those beliefs are now making them poorer. What's happening is, for example, 20-25 years back, FDs would, yield a larger return. That point in time, you'll hear it from, elders, your parents and, relatives saying you need to buy a house. That also, earlier you could buy it with much lesser amounts. When I say amounts, compare that to the money that people make on an average, then compare, that to the price of the house. For example, earlier you could buy a house with 2-3 years of income. But today, if you have to buy it, it's 15-20 years of income. So what has worked historically, that's not the same position today. The advice that we end up getting from them continues to be the same. But as investors today, we'll have to adjust to what the situation is and then accordingly, take a different route to, be successful.
I think I can add to that. So, 20 years ago, equities wasn't as much as an asset class that was as available like as we speak today, right? Like today with mutual funds, SIPs. So I was speaking to my grandfather yesterday, and he was speaking about how this year we didn't even see a 1% per month return, and the thought process is very like, okay, I need to make at least 12% per annum because that is the cost of capital. I think those thoughts are correct, but it's just that back then the only option was, say, real estate or gold and land. That was like where the large investments would be, and equities was not even an option because our country was not as mature. Today that has opened up. So I think there are some families that have succeeded, that have understood this and have transitioned out, but there are some traditional ones that have not been able to achieve this and have not been able to transition out into equities. So I think that big gap needs to be filled from a family perspective.
In fact, if we talk about, let's say, the amount of signatures needed earlier to just open a Demat account, I remember Nitin Kamath saying like you needed some 30, 40, it was a big document. The entire process of getting into equities as an asset class has become so simple. So let's talk about these myths that they carry, right, one by one. So the first one is one common belief that many Indian households and these families have is that having cash is a safe option, especially in crisis. That is the cash reserve that they, try to build. What do you think is the approach there? Like, what's the right thing to do?
See, there are some families that have actually understood this back in the past, maybe unconsciously and not consciously. So when people were investing in something like real estate or gold, they were taking care of stuff like inflation, currency depreciation, by itself. So at least the smart families understood this. But there are some that were, we end up speaking to a lot of investors, and a lot of them are sitting on FDs and debt funds generating 6-7%. And the post-tax, the returns are 3-4%. And the thought process is, oh, like markets are really volatile, and it's better to keep your money in an FD than to see that 10-15% drawdown. So I think there's a big knowledge gap out there. So the ones that have been able to understand this and transition out of the thought process that FDs are safe and I need to move either to equities or hold any sort of real asset, I think they've been, able to succeed. So I think that myth of holding on to any sort of cash is partially true for some families. Some families are doing it unconsciously, wherein they are yet invested in their business, yet invested, in real estate. So at least, they don't have currency risk, or they don't have any sort of inflation risk out there.
What has happened is, today there are some, families that are still carrying the old values, which generated a lot of wealth 25, 30 years back. For example, they could be depositing their money in FDs. They could be, buying, real estate. What is happening is the yield that you would get 15, 20 years back, those yields are not true today. So you might be thinking that, hey, I am doing the right thing. But let's say 20 years later, you might not end up seeing that result in your portfolio. The idea is for us to analyze where can I see that growth in the next 15, 20 years, and then the idea is to take that action, for example, today. If you think that the highest return generator over the next 15, 20 years is going to be equities or it's going to be gold, you'll need to be, taking positions in that. Not that we are saying that real estate is a bad bet. For example, if you end up buying a piece of land, that we still think will continue to grow. But let's say if you end up buying real estate in a particular building that's already selling at a premium, and the idea is parking your money there and thinking that would grow in a place like Bombay, I think that from a return generation perspective does not make sense today.
While we're having this discussion, I think there are two aspects to this, one from a business thought process and one from an investing thought process. I think on both ends, a lot of people have had some sort of backlash. From a business mindset, when they started 20, 30 years ago, if you were just skilled enough to, set up a factory or just provide that basic service, or, even have a small store, you would succeed, right? But today that does not exist anymore, and it's hard for some people to, grasp that. I think today, how much you might have thousands of crores, but if you're not bringing actual value to the table and you don't have some talent, absolutely anyone can, go far ahead of you. And that's what we've seen even in the US, right? Like, kids who are 21-year-olds are, having billion-dollar startups, and, that's how I think the world is changing, and that's where business families are finding it hard to sort of maybe maintain their position also. So, yeah, Pradeep.
Another deeply held belief that they have is that, we'll invest when things become more clearer and wait for clarity. What ends up happening is they don't invest when they should. So how would you want to answer to this particular myth that they hold?
Sure. So I can explain this to you with an example. Someone who I know in 2022, exited all of their portfolio saying, Russia-Ukraine war is going to happen, things are going to escalate, things are going to go south. It's been 4 years, never been able to come back, in terms of where the portfolio would have been today, just basis this news. If you open an article 25, 30 years back, you'll, definitely see one angle saying how much risk there is, in the market. But the view that you will need to take is more from a 5-year, 10-year standpoint, saying where will things be in 5 to 10 years. Understand that there could be short-term blips. Understand that you won't be able to time each one of those. So volatility is always going to be a part of it. You're never going to be able to say that okay, today entire volatility has gone away and I can take a call. You'll still be taking a call with some level of volatility still being there in the market. But the idea is to live with that volatility and see the upside.
Right. I mean, if anyone wanted to answer the question that when COVID-19 would end and they would wait for that, you would have missed out on the entire rally that market saw. So waiting for clarity clearly, would give you a bad entry.
I think that what matters is if you're coming from a place of knowledge or you're coming from a place of speculation. Most people end up coming from a place of speculation that, oh, let me wait and let me time the market. If there's a very deep understanding, you have a research team, you yourself are doing deep research, I think, there are people who can successfully time the market, but that requires a lot of work and a lot of effort. I don't think so, each and every person can do it. So, depends from where you are coming.
let's talk about another angle, which is many business families have another myth, which is, that taking investment advice from my friends, family, or someone who knows about stocks, some uncle, is enough for me to manage my portfolio, right? I don't need professional advice. What would you say for that?
I think what we realize is that when we end up meeting, say business families, we end up looking at their portfolio because that's something that's in our approach, right? We want to understand where they're coming from, and they end up having generally 70-80% of these families end up having 100 to 200 stocks in the portfolio, and they don't understand that. Listen, this is not the right approach. Now, how do they end up, doing something like that? Is that we realize that generally the head of the family, could be say a 65, 70-year-old, has built the business himself. Right, so he has sort of generated all that capital, started from scratch, maybe come from a remote village and moved to a place like Bombay, Delhi, etc., and built everything from scratch. So they feel that it's they need to be in control, and when they feel that they need to be in control, they think that control means taking the decision of buying a particular stock, and they aren't going back to do any sort of traditional research because that's not their background. And giving money to a fund manager seems like, oh, he's going to take a fee, or putting money in a mutual fund seems like it's not good enough. And
I'd rather do it myself.
I'd rather do it myself. But the you need to understand the entire art or science of investing has lots of small moving parts to it, wherein you need to be able to quantify everything that you do. And most families don't end up looking at their CAGRs, and one or two success stories in 100 stock portfolio makes them feel like, okay, fine, they're good at this, and fund manager is not good enough. So I think the thought process comes from a very controlling mindset. Having said that, then there is a second and a third generation who actually understand this, and we've seen this. There is always some sort of friction between the first, second, and the third generation, where the third generation understands that, okay, fine, like there are guys who can do this, or if we have to do this, then we need an internal team or a setup, so that we can do this professionally. So we've had that experience where we are seeing the second and the third generation being convinced that we need to move to a much better approach, but the first generation doesn't want to sort of give control.
One thing that ends up happening now, Nifty gives 12% return over a 20-year period, like we all know that. But if you look at the stat, investors don't end up getting 12% return, over a period of time. So what ends up happening is people who end up taking these calls by themselves, end up adding to, let's say, small caps at the wrong time, maybe at its peak. They end up exiting that at worst time, when actually it's an idea to invest, in small caps. They could be entering, let's say, a particular commodity, in a wrong cycle, entering equities at wrong cycle. So I would say this, process keeps compounding over a long period of time. That's the reason why, investors trying to do this by themselves don't end up, generating that, return over time. So the idea is, how you would trust professional for other tasks. The idea would be to trust finance professional for the task that they do. Now, taking advice, they'll also tell you what to buy. They will not tell you how much to buy. They will also not tell you when to sell. So there have been times when people are holding stocks for 5-6 years just because someone said that the stock might go up, and their time horizon could have just been 1 year. So you don't know when to exit, and you continue holding.
That's how you pile up to a 100 stock portfolio.
Exactly. And then what you end up saying is, let's say if you have for example, 10 crore portfolio, you end up buying worth 5 lakhs. That ends up tripling, and you feel like you've made a very big decision or a large gain, but on the portfolio basis you've not done that much. If you are totally convinced about a particular stock, you can also take a much higher position size, but you're not able to do that because it's someone else's research. So I would say people trying to do this by taking advice from other people, in over the last 15-20 years, I feel that number has gone down, and I think that number will continue to go down, and people will reach out to professionals for advice, whether it's a wealth manager or it's a mutual fund or if it's a fund manager within a PMS. I think people will continue to do that, and that will keep increasing.
Another question for you. If we look at how the edge comes, right? So let's say information edge, or let's say the network that these families have. how big a role that plays into alpha generation, and how relevant is that even today with the kind of democratization of investing and everyone have access to everything? How much does that give them an edge?
What we've realized is I think there is an edge in the private equity space, in the pre-IPO space, wherein there are certain deals that are not out there for a retail investor and only come to you because of ticket size, right? So specifically when you're making investments of north of 5 crores and above, as we speak today, I think those deals only come onto the tables of large family offices, wherein merchant bankers and larger players go up to them, and we've seen a lot of people create a lot of wealth out there. A live example of that has been with in the solar space with Wari. The pre-IPOs have happened at about 400 and 500 rupees, and maybe now the stock is at 3,000 and 3,500 rupees. So these deals have been have come on the table for these families, and I think there is an edge out there in the equity space specifically. Once because most families have larger sizes in the mid caps, large cap space, it's very hard to find an edge out there because information is asymmetric, and the only edge that lies is that when you have access to private wealth players, maybe you have some more information than just a retail investor wherein you could meet the management. But I think that that is not of as much value. I think you can yet outperform as an individual investor. So I think that's the cool part about this game, right? You can be at home and you can outperform a family office, specifically in the listed space.
Yeah. No, so I agree with him. I think, where there could be edge, in terms of information, as Rishabh mentioned, could be private equity or venture capital stage. What ends up happening is when you're playing the private equity game, it's not about, getting every bet right. For example, the hit ratio or a super hit ratio for a private equity firm would just be 20%, where 2 out of their 10 investments end up doing really well. For example, if you take a step back and look at venture capital, you'll end up seeing that the hit ratio is only 10%, where one big bet ends up paying for the remaining 9. So it's not like investors can play the game saying selectively I can only do 2 bets and that bets will end up making an outsized return. The odds are against you. It's possible that someone can do that, but generally the odds are against you.
But the ticket size is large, right? Like in a sense, so then you can't play this as a small player anymore.
Yeah, no, I'm saying, for example, if you have 50 crores and if you want to do this with 5 crores over 10 companies,
then you can
that
do
could
it.
still make sense. But if you have 10 crores and if you want to spread it over 2 bets, 5 crores each,
It'll not make
then
any
you can't
sense.
do that.
Yeah.
But I'll tell you, there are also, let's say, same example, if we move it to the public market side, now someone could have a 40-50 stock portfolio. They could have a lot of information, maybe because they're connected within that industry or connected to maybe the promoters. It's possible that that number is only 10% of that. They have good information about 10% of their companies, and the remaining 45 companies in their portfolio is built on, as we say, friends and family and someone else who they thought had good knowledge on that. So what ends up happening is you might think that, hey, I am only taking bets, short bets that are going to work out. But if you take a deeper look, you'll understand that the portfolio that I truly understand is only 10% out of the 50 companies that are holding that I'm holding. So it doesn't end up being true that you have an inside edge for all the companies that you're holding. At least from the portfolios that we have seen, we have not concluded that that's true.
Since you also worked in the private market space, the 10 companies that they end up investing, how many companies would they be looking at versus rejecting? Like, what's the number?
The hit ratio is extremely less. For example, when I was working, in a private equity firm before, to invest in 8 to 10 companies, you have to, go through 3 to 400, companies. And then from that, if you're lucky, you'll end up finding, 8 to 10 companies. Also, what happens is, for every company, that you're rejecting, bunch of them end up being like, the other companies also end up, being the same companies, doing the same thing, end up doing, end up building the same product. So you end up getting a good understanding, of the market, and the one that you really invest in, you have a fairly decent knowledge about that. So I cannot look at the first company and then assume I know everything about that particular company. I have to go through that cycle of understanding the entire sector, understanding 10 different companies from that sector, and then end up investing in one that works out the best. So as a process, you should assume that the hit ratio is definitely, less than 2%, for you to end up investing.
So, if these myths are so counterproductive to returns, why do they still fall prey to these, these kind of myths? Like, why does that happen?
The problem that we are facing today as families is that thought process is flowing down from the top, and then we end up imbibing everything about that thought process. So the first generation, the 65-70-year-old head of the family, ends up designing the thought process, and then everyone has to sort of abide by that thought process. I don't think so there's a problem in abiding by values and principles, but I think there is sort of a challenge out there if you're going to completely stick to investing techniques or business techniques. I think that needs to be a constantly evolving process. Let's not even talk about families. If you look at large corporations, the S&P 500, out of the 500 businesses that existed in that circle about 20-30 years ago, only today 5 or 7 end up surviving, right? So even large corporates with professional managements face that problem. So I would have, we're not surprised that business families are facing the same problem today. So I think the way to sort of survive something like this is to accept change. And I think Amazon does this really well. If you look at large corporates, they end up focusing on their primary business always. They only end up focusing on whatever is the main cash flow, and all resources are put out there, and then seeds are not sown. In Amazon, the idea is that even if it's a $1 million idea, it's given significant importance. So within the family also, if we can give the lower generations that freedom to for new thought processes, new ideas, I think can be successful.
Right. So, if unlearning and relearning is such a big part of it, right? What are some of the examples that you had to do in markets to stay relevant?
I think one of the things was that I used to read, say, like a lot of, say, Buffett and Peter Lynch, etc. And the idea was always remaining invested. Now, I think that yet holds true. Okay, that you want to always remain invested, but I don't think when they're trying to say that always remaining invested, I think they're not trying to say that like don't time the market or whatever the price is, enter at that price. At the same time, they're also explaining another concept. So for me, I always thought that okay, fine, regardless of price, you want to get in. So I'll tell you the mistake I made back in after we saw the 2014 to 17 small cap rally, 2018 Jan Feb, we thought that okay, fine, this should continue and we should always remain invested. And we were 100% invested back then, and we deployed a lot of AUM back in the peak of the small cap 2018-17 end. And I think we entered that with the thought process that okay, fine, it makes sense to always remain invested, but the next 3 years we saw large drawdowns, right? So the myth was that we need to always remain invested. I think it needs to come with a pinch of salt that if valuations are extremely tight or really high, then you can't get in at those prices. Warren Buffett himself today sits on 40% cash. The fact that you sit on 40% cash means that you're trying to time the market. Maybe this does not apply to a retail investor or someone who has no time to study the markets. Then I think yet the better option would be you do an SIP. But entering at absurd valuations is sort of something that we refrain from now, and allocation becomes a very important play if you want to look at high double-digit returns.
Yeah, absolutely. And this is what we tried to do. That was a learning from 2018-19. The idea was how do we make not make the same mistake again. So the idea is we internally built a set of quant indicators. I'll just give you an example of one particular indicator. So we try and see overall how the market is valued, and then break it down segment wise, large caps, mid caps, small caps, and micro caps. So the scale is on 0 to 100. 100 means extremely overvalued, 0 means extremely undervalued. You'll never get those extreme situations, but let's say you get a score of 80. That means it's extremely highly valued, and you need to take some chips off the table. That means you need to be not investing 100% in equities at that point in time, and maybe try and look at other things. So a live example I can give you now. In September of 2024 till December of 2024, we were getting a signal that market was close to 80. And then that's when we took a call that, we need to be investing our funds in safer assets rather than aggressive assets. And, we saw that, if you look at just the returns in Code All Weather product that we have, it's north of 35% over, last year. Now, over time, slowly signals have changed. So the score that was at 80 at that point in time has currently come down to 50. What we are doing right now is still sitting some in safe funds. Some of the allocation, about 50% of the allocation, we're deploying it towards aggressive. Let's say if the score comes down from 50 to 30 or 20, we'll be moving everything, 100% of that, to aggressive funds. So firstly, information like this is not available to investors themselves or family themselves. Only if you've spent 5 years in the market, doing this as your full-time thing, only then will you be able to build such models. So either they could try to give the capital to professionals to manage, or understand that this is a limitation at our end, and how can I avoid that limitation. That could be, as Rishabh said, that you could try and do an SIP and get away from the idea of timing the market.
All right, time for our scroll check. We've pulled out some posts. You know the process. So I'll just be reading out some posts and I would love your reaction. First one is, my grandfather bought land in Gurgaon in 1995 for 8 lakh rupees. Today it's worth 12 crores. That is 150x in 30 years. Show me one stock that has done this. Real estate is generational wealth. Stocks are casino chips. My family has been in property for 3 generations. We do not need a fund manager to tell us what to do with our money. Land never goes to zero. Nifty can.
So I think I think it's great that like 150x was the return. Those kind of opportunities are something that we call deep value in the markets that we see today. I don't think those kind of opportunities exist again in terms of real estate. In the markets, those kind of opportunities exist because markets have gotten a lot more mature. You're right that real estate will not go to zero. I think you're wrong that Nifty can go down to zero. I think you can see drawdowns, and that's just volatility. When you say Nifty going down to zero, that means that 50 of the largest businesses have to shut down, right? Which does not sort of cannot happen. That 50 of the largest businesses shut down. We saw that once happening in COVID, but back then everything, right? If 50 of the largest businesses shut down, you'll be more worried about your land because there'll be no takers out there.
So Pratik, one more thing I want to add here. A lot of the times people don't understand the return that they are generating. For example, now if I ask you 150x over 30 years, how much is that on an annual basis? Most people who got that kind of return won't be able to answer that question. I asked a similar question to someone who had invested in, silver, who gave me, same example, and they spoke about how much multiple times it had gone up last 20 years. I asked them, how much annual return have they gotten? They couldn't come up with the answer. Now, if I just talk about the example that you gave, the idea is it should be, close to 16-17% return. The idea is if you get 25% return, your money becomes 10x in 10 years, 100x in 20 years, and 1000x in 30 years. So they've gotten 150%, 150 times, which is roughly about, let's say, 17%. Now, what if you understood this, and then realize that there could be some other place where I could get 20%, 25% return over a long period of time? Would that end up generating that kind of wealth for me over the long term? And the answer to that is definitely yes.
Okay, so the next, you do not need a wealth manager. My CA has been handling my investments for 15 years. He knows my tax situation, my business income, my family needs. He puts me in a tax saving ELSS, some FDs, LIC policies, a few direct stocks his broker friend recommended. Total cost zero. These wealth managers charge 1 to 2% fees, then underperform the index anyways. Why would I pay someone to do what my CA already does for free? The best financial advisor is someone who already knows your books.
I think there isn't a problem with CAs doing something like that. I would just recommend that why don't you look at the track record? People don't end up actually measuring, and I think the most important thing over here is to be able to measure what you have done. Generally people end up, I gave 50 lakhs, it's become 1 crore. But if it took you 6 or 7 years, then you've just compounded at 11-12%. So the idea is that can you measure that? If you can and you've outperformed, then there probably is a science to it.
Coming back to the point where people don't understand how much returns have they made over a period of time, I can tell you that out of all the portfolios that we see for our investors, which they've been holding for years, we ask them what's your return over the past 5 to 10 years. 90% of them, and the number could be higher, they don't know what the annual return is. In this case as well, what ends up happening is the cost, you think of it as a 1-year cost, but the return is over a 5-year, 10-year period. It's possible that the CA has done a good job. It's possible that you still want to continue to do that. But today there are so many, let's say, apps available. There are so many options available where you can just track how much return you've made, from your existing investments. I would say if that number, ends up being 15, 16% over the past 5 to 10 years, I think the number is, good enough. You should just also additionally watch that you're not taking excessive risk to generate that 15, 16% return. You also try and track, risk adjusted return rather than just returns. And if your number is closer to the market or slightly better than the market, then you should continue to listen to whoever is giving you that advice.
So you talk about, tracking your portfolio. Is there a way where we help investors, get this kind of information, detailed analysis on risk reward, etc.? Would you want to, maybe give some clarity?
Absolutely. I would say, see, there are a lot of places in the market where you get that information. At this point, we are also trying to build something, for the people in general. We're trying to build an app where you can just upload your portfolio and you'll be able to see your historical returns over the last 20 years. You'll be able to compare how has my large cap performed to the market, large cap. How has, let's say, my small cap performed as compared to the small cap, small cap index. You'll be able to see whether I'm taking more risk versus less risk. The idea is once you have good information about this, you might not have to change your entire portfolio. You just have to realize that maybe my small cap bets are not working and I need something else that can help me manage that. Or if there's something else wrong with the portfolio, you can help, change that.
All right, speaking of questions, now we are going to the segment where we've got questions in our newsletter. So I'll just be pulling up those, which is answering the internet segment. I inherited 5 crores from my father last year. He kept it in LIC policies, NSC, PPF, physical gold. Touching my father's investment feels disrespectful. What do I do?
I think, what happens is that when you come with some sort of, baggage, which is, I would that when you are coming with, say, legacy or with money in the bank, it comes with a little bit of, responsibility, and you find it hard to sort of deploy it in something like equities because you're too scared to lose it, as against when you started from scratch. Right? If someone who started from scratch and even has gone to 400-500 crores would be taking even more risk. So I think so you have to figure out a way to detach yourself from that it's come from my father and it's my father's money, and you need to be able to take an objective decision.
Next question is, everyone in my family thinks the stock market is just like Harshad Mehta era. How do I convince them that markets have fundamentally changed?
Again, this is talking about the mindset, what was true, let's say 25, 30 years back versus what is true, right now. At that point in time, a lot of people felt that, maybe because they lost the money, at that point, there was a point where market was in bubble and, it crashed after that and everyone started thinking that it's a scam. I would say that in today's world, it's still true that, sometimes the market could be in a bubble. It's still possible that, markets, could offer extremely good returns over the next few years because it's undervalued. So all those situations continue to be there. It's just the way it has happened has, kept changing. But from a 5-10 year standpoint, you need to stop thinking about that I'm investing in, stocks. You need to be thinking about I'm investing money in companies, companies that are actually looking to grow, companies who want to increase their sales, increase their margins, increase their exposure, increase their, penetration across different geographies. If you end up thinking about it from that mindset, you'll actually, start seeing that, you start seeing yourself as an investor in that company rather than being a stockholder in that company.
Okay, thank you so much. Thank you for being here, guys.
Thanks, Pratik. Always fun.
Thanks for having us, Pratik.
If this conversation helped you think clearer, subscribe. And for more market insights delivered straight to your inbox, hop on to our newsletter.